The main engine of economic exploitation is the financial system's ever-increasing extraction of value through interest payments, according to economist Michael Hudson. Paul Craig Roberts finds his analysis all too accurate, as the over-financialized economies of Western countries head down a spiral of poverty, decline, injustice, and despair. The world is facing multiple crises when it comes to our climate and environment. We know this too well. We are direct witnesses of this destruction and the suffering it causes in our respective countries. Brazil and Indonesia, two countries that are home to ecosystems vital to the ecological balance of our planet. Today, we embark on a comprehensive exploration of a critical topic: how certain finance practices, when not properly regulated, can lead to widespread and profound consequences for our global society. Finance encompasses a broad spectrum of activities relating to the management of money, including investments, banking, lending, and more. While finance is undoubtedly a cornerstone of economic development, there are aspects that demand careful scrutiny due to their potential for unintended, far-reaching impacts. Often, a financial crisis is caused by overvalued assets, systemic and regulatory failures, and resulting consumer panic, such as a large number of customers withdrawing funds from a bank after learning of the institution's financial troubles. Some believe that financial crises are an inherent feature in how modern capitalist economies function, where the business cycle fuels speculative growth during economic booms, only to be met by contractions and recession. During these contractions, borrowers default on their loans and creditors tighten their lending criteria. A significant issue within finance is the prevalent short-term focus adopted by many financial institutions. This emphasis on immediate gains can lead to speculative activities that contribute to market instability and economic crises. Financial systems fail generally caused by system and regulatory failures, institutional mismanagement of finances, and more. Historical examples are plentiful, such as the dot-com bubble of the early 2000s and the housing market crash in 2008, which demonstrated the perils of short-term thinking. According to a study by the National Bureau of Economic Research, the 2008 financial crisis resulted in an estimated 8.7 million job losses in the United States alone. Although the crisis was attributed to many breakdowns, it was largely due to the bountiful issuance of subprime mortgages, which were frequently sold to investors on the secondary market. Bad debt increased as subprime mortgagors defaulted on their loans, leaving secondary market investors scrambling. Investment firms, insurance companies, and financial institutions, slaughtered by their involvement with these mortgages, required government bailouts as they neared insolvency. The bailouts adversely affected the market, sending stocks plummeting. Other markets responded in tow, creating global wealth inequality remains a pervasive concern in today's economic landscape. While finance can serve as a catalyst for wealth creation, it can also exacerbate disparities in income and assets. Research indicates that the top 1% of the global population holds over 44% of the world's wealth, while the bottom 50% collectively owns just 1%. Oxfam's 2021 report highlighted that the world's billionaires saw their wealth increase by 3.9 trillion between March 2020 and December 2021, while the pandemic pushed millions into poverty. Finance wields immense power in shaping our environment, a realm that demands our utmost attention. Some investment practices prioritize immediate gains over long-term sustainability, leading to detrimental impacts on our planet. The Financial Times reported in 2020 that global regulators had fined financial institutions more than $36 billion for various misconduct since the 2008 financial crisis. It's crucial to recognize that the effects of finance are not confined within national borders. In our interconnected world, financial decisions in one part of the globe can have profound repercussions on economies and livelihoods worldwide. Financial crises are not uncommon. They have happened for as long as the world has had currency. Some well-known financial crises include Tulip Mania 1637, though some historians argue that this mania did not have so much impact on the Dutch economy, and therefore shouldn't be considered a financial crisis. It did coincide with an outbreak of bubonic plague, which had a significant impact on the country. With this in mind, it is difficult to tell if this crisis was precipitated by over-speculation or by the pandemic. Stock crash of 1929. This crash started on October 24, 1929, saw share prices collapse after a period of wild speculation and borrowing to buy shares. It led to the Great Depression, which was felt worldwide for over a dozen years. Its social impact lasted far longer. One trigger of the crash was a drastic oversupply of commodity crops, which led to a steep decline in prices. A wide range of regulations and market managing tools were introduced as a result of the crash. The 2007 through 2008 global financial crisis. This financial crisis was the worst economic disaster since the stock market crash of 1929. It started with the subprime mortgage lending crisis in 2007 and expanded into a global banking crisis with the failure of investment bank Lehman Brothers in September 2008. Huge bailouts and other measures meant to limit the spread of the damage failed, and the global economy fell into recession. Over the course of 5 days in March 2023, 3 small to mid-sized U.S. banks failed, triggering a sharp decline in global bank stock prices and swift response by regulators to prevent potential global contagion. Silicon Valley Bank (SVB) failed when a bank run was triggered after it sold its treasury bond portfolio at a large loss, causing depositor concerns about the bank's liquidity. The bonds had lost significant value as market interest rates rose after the bank had shifted its portfolio to longer maturity bonds. The bank's clientele was primarily technology companies and wealthy individuals holding large deposits, but balances exceeding $250,000 were not insured by the Federal Deposit Insurance Corporation (FDIC). Silvergate Bank and Signature Bank, both with significant exposure to cryptocurrency, failed in the midst of turbulence in that market. By 19th March, concerns about the banking sector internationally had increased. That day, Swiss bank UBS Group AG bought its smaller competitor Credit Suisse in an emergency arrangement brokered by the Swiss government. 1 month before the events in the United States, Credit Suisse had announced its largest annual loss since the 2008 financial crisis, as clients continued withdrawing their cash at a rapid pace. $147 billion had been withdrawn in the fourth quarter of 2022. It also disclosed it had found material weakness in its financial reporting. Its largest investor, Saudi National Bank, announced on March 15th that it would not provide more support to Credit Suisse. Its share price plunged 25% on the news, and UBS stepped in to buy the bank. Axel Lehmann, former chairman of the bank, later sought to blame the American bank failures for triggering Credit Suisse's demise, though other analysts disputed that characterization. The bank had experienced many years of multi-billion-dollar losses, scandals, executive turnover, and weak business strategy. While rising interest rates give banks greater returns on customers' loans, the tighter financial conditions meant the sector saw a downturn in equity funding, with the S&P Bank Index (SPXBK) in April down 14% year-to-date on expectation of lower quarterly earnings for some U.S. banks. Effects on the secondary market were also expected. On April 11th, the International Monetary Fund downgraded its forecast for GDP growth globally in 2023 from 2.9% to 2.8%, saying, "Uncertainty is high, and the balance of risks has shifted firmly to the downside so long as the financial sector remains unsettled." The recent crisis highlights a structural problem in our current financial system. There needs to be a safe place for businesses to place their reserves and working capital without providing funds to speculative financiers and without fear that their deposits will be wiped out in a bank failure. That, among other reasons, is why we need publicly provided accounts where households and businesses can hold their money risk-free. A healthy economy needs a set of basic institutions that provide financial services to families and businesses that facilitate their productive and necessary activities. The problem with private and more speculative banks, like the ones that dominate our economy, is that they provide poor and costly services to most families and smaller businesses, and when they do, such as offer deposit accounts, They often put these at risk by engaging in highly leveraged and overly risky activities that often have little social value. While finance remains a linchpin in our economic system, it's imperative that we champion responsible practices. Transparency, ethical investments, and comprehensive regulatory frameworks are essential for ensuring that finance benefits society as a whole.